Welcome, everybody. I'm joined with a fantastic lineup of investors that I know quite well who are investing across sub-Saharan Africa, but also in North Africa. I know a lot of these investors are heavily focused on growth stage, but also have done some early stage investments in their portfolio. So maybe I'll just kick it off and ask everybody to do a very brief introduction. I'll kick it off and start with myself. I'm Lexi Nowitzki, based in Lagos, Nigeria. I'm the managing partner for Acuity Venture Partners and also the general partner for Norskin 22. Those two funds, by the way, don't overlap. We are wrapping up the last Acuity fund and joining forces to launch Norskin 22. Pardon, over to you.
Thank you, Lexi. Super excited to be here. My name is Pardon Makumbe. I hail from the incredible country of Zimbabwe. I'm a co-founder and managing partner at CRE Venture Capital. Super excited about the work that we've been doing and the work that lies ahead, backing early stage tech-driven companies from across the region.
Thanks. Tijan.
Thank you, Lexi. I'm happy to be here with you guys. I'm Tijan. I'm based in Senegal. I'm partner at Partech, running the Partech Africa Fund. We invest in venture stage across Africa in 15 companies now in 9 countries.
Great. Aniko.
Hi, my name is Aniko Sigetvari. Thank you for the opportunity to be here. I'm a founding partner of Atlantica Ventures. We are an impact-focused venture capital fund investing from seed to Series B rounds in tech and tech-enabled companies across Africa.
Fantastic. All right, so I'm gonna kick it off with a question that I get asked all the time by other investors looking at the ecosystem and my LPs. So we've seen a lot more money flow into the ecosystem, and some would argue there's a lot more confidence of returns given that we've seen exits and probably the market size expanding. But with currency risk, consumer spending ability, regulatory risk, all kinds of barriers still there, are the increase in valuations that we're seeing really warranted? And maybe how are you thinking about your own strategy or your entry points, given where we've seen valuations in markets, especially like Egypt and Nigeria, expand?
Well, I can start. So whether increased valuations are warranted or not, they're happening. The VC market across the globe is really hot. And based on that, and also some recent exits and successes in the African startup space, there's definitely a spillover effect into Africa. There's also US money and money from China also crowding into the market. So that's a matter of life. So the way we think about it in this environment is, as we value companies, is to see what the next round is likely to be like. What is it gonna take to get there? Does the company have enough, can it raise enough funds and has enough runway to reach the KPIs that are needed for the next funding round? And then does that align with our expected return based on the analysis that we do and the valuation that we do? And in terms of what's a good entry point, we're early stage, so we do pre-seed, seed, and Series A as new tickets, and then we follow to Series B. And we're sticking to that thesis and strategy, and it seems to be aligning with the current market environment, because there tends to be still a bit less money and maybe less competition in the earlier rounds.
Yeah, definitely. Pardon.
Great question. Firstly, thanks for asking that. I think the answer from our point of view is probably, for some companies, yes, the valuations that are higher are warranted. For some companies, no, they're not warranted. We think the devil as always is in the detail, right, of which company you're talking about. And often we're looking at what's the size of the addressable market, what is the business model, right, and how well suited are the founders to the specific task at hand, or the specific task of building the specific company. So, and I think you will find companies that are probably undervalued in this environment vis-a-vis these parameters. And you find a lot of companies that are also overvalued in this environment. So I think it always boils down to the specifics of a company. Then I'd say a second point that I'd make is we try to take a really long-term view of what a company's life cycle will look like. What does the next round look like? Absolutely. But in addition, what do the next 5 rounds look like? Are there 5 rounds that should follow? What do exit scenarios look like, right? How does that business perform in the very long run? And I think when you take that view, again, you come to the same conclusion. Some companies are actually appropriately priced, some are actually undervalued, some are actually overvalued vis-a-vis those long-term considerations. Right? But I would say that's how we would think about it.
Yeah. And maybe Tijan, as you answer this, I've heard a lot about thinking about the next rounds. So are all of you thinking about maybe your exit coming into one of those next rounds, or are you more thinking about an acquisition or even an IPO? Is that coming into your exit scenarios at all?
Well, actually, in this slide, I actually envy my colleagues here who are investing in earlier stage, because valuations are getting high everywhere, and this is also happening in Africa. And when that happens, of course, pre-seed and seed seems much more comfortable, especially as in Africa right now, I feel like valuation inflation is happening more in higher rounds. It's great for pre-seed and seed investors. It creates opportunity for liquidity in secondary early on. That, again, I envy a lot. However, I think ultimately what you're hearing in this room is we're all taking a pragmatic approach to this valuation conversation. We look at, how much we can sell this company. What will be the multiple when we sell? The cycle of multiples is high right now. What will it look like in a few years when we will be selling our stake? And that should be taken into account. If we think we will get a reasonable exit, we will take the valuation. That's the pragmatic approach. Does it create I'm not sure this is linked really to the timing of exit ultimately, because when you invest, again, pre-seed, maybe you can exit secondary at B or before. When you invest like us in A and B, it's more likely to be M&A or something later down the road. And again, that's the liquidity question is key for us.
Yeah. I also want to talk about where you all see the opportunities that you're focusing your attention on, whether that be geography or broad sectors, but more specifically, I'd like you to dive deeper, not just talk about fintech, but maybe dive into neobank or open banking, whatever it might be. But please also give some love to subsectors outside of fintech. But I'd love to hear from all of you what you're excited about now and what you think is overlooked in the market that has a huge potential in the next couple of years. Whoever wants to kick it off, please.
You mean we have to talk about doing not fintech and not Nigeria?
That's MySpace. I've got that covered.
Let's focus on everything else.
And maybe I'll start. Oh, sorry.
Go ahead, Annika, please. Go ahead.
Despite mentioning we shouldn't talk about fintech, I would say there's still opportunities in fintech. So insurtech for me, for example, is one area that's really interesting. That's an issue in Africa, but it's actually a global issue usually in developed and emerging markets everywhere. And it's tech that can be scaled within Africa and to other regions. So I find that to be interesting. Embedded finance, very much so in its very early stages, and we see some opportunities there that if you look to other more developed markets, if you look at as a guiding light, could be really successful sectors. And for us, as there's a lot of development in fintech, there are lots of fintech companies, they're starting to bump into increasing compliance issues, especially as they go to multiple markets. Then they're looking at security and hack issues increasingly. So we are looking at, on the back of that, digital security as one of the areas that are very early stages, but we see huge opportunity in the medium to long term.
Yeah, absolutely. And Aniko, do you think that companies focusing on digital security and maybe even cybersecurity can compete with global markets like Israel or the US?
Yes, so because you need a lot of the time tailor-made solutions, you need to have the local knowledge and market experience. So I think if you mention those companies, I look at them as potential acquirers of the businesses that will need to be developed and accelerating as startups in Africa. I think most of those companies will come in and don't do greenfield, they'll do buy instead of build. But in the immediate future, that's not going to happen. And there's a huge need in this space. So we're quite excited about making investments in this space.
Absolutely. Tijan.
No, I was going to say earlier that we pride ourselves into being generalists and being willing to take anything that comes and being very opportunistic. However, first, yes, fintech is not done. One of the learnings, at least from my side over the last few years, is that even in areas that look pretty covered, it's possible to see a startup come and displace the status quo. Mostly because, frankly, on each of these sectors, we've only seen the first wave of digitization. Things that are much more sophisticated are coming up, need to come up and replace the first guard of digital players. So there's still a lot to do in fintech. I join Aniko in being very bullish about the insurance space. It is a low penetration sector in Africa, and it benefits hugely from digitization. But frankly, if you look, this happens in every single vertical. If you look at what's been happening in agriculture, it's been mostly fintech. Whether it's insurance or credit. So there's still a lot to do there. But on the other hand, and this is something I as investors, we must all be excited about. I see a lot of opportunity in this trend where entrepreneurs are taking these very operational, old style economy, parts of our economies, and just going there and building digital plus operation, which is pretty hard, but super valuable. There's been a first wave in the logistics. There is another wave in supply chain. And I think mobility is next waiting to be disrupted this way. These are huge parts of our economy. So obviously they will be big opportunities for us.
Austin, pardon, where are you seeing the opportunities that are overlooked?
There's very little to add on what Aniko and Tijani have already said. I think such remarkable and thoughtful insights into some of the trends. I would say as CRE, we are generalists, right? And we are sector agnostic. And for us, we just try to keep a sense of where founders are doing the most work and where we find high quality founders, right? I do believe that there are ways to make money in fintech and there are ways to lose money in fintech. There are ways to make money in mobility, there are ways to lose money in mobility and so forth. And so for us, again, it always boils down to the specifics of, hey, what is this company proposing that they will do? Are the founders that are building it the right people for the job? As relates to their domain experience and relationships and so forth. And do we believe that there's a compelling business model? Over the years, we have backed companies in a wide range of sectors. We've backed companies in financial services, obviously. We've backed companies in education, in mobility, in travel and hospitality, in sort of enterprise software productivity and so forth. And we think there's layers and layers of opportunity. As Tijana said, a lot of the innovation has been the first wave of innovation, and there will be layers and layers of other innovation that will come down the pipe. So we think there's a wide breadth of opportunity and where things could go. But I think, ultimately, you back a founder, you back a team, you back a company, and that's always where we think the rubber hits the road for us, right?
So especially to you and Tijan, although Aniko, I'm sure, has some thoughts on this as well. You mentioned being generalist and being very opportunistic and looking at pipeline and deal flow. But there is a lot of pipeline and deal flow. How do you manage all of that? Do you really filter through everything? Do you have tools in place to make it more seamless? Do you just follow deals based on referral? How do you manage that pipeline, which is always a problem for us with such a small team?
It is hard. I mean, I like to say every 12 to 18 months, venture in Africa is an entirely new environment, new ecosystem, new players, new pricing dynamics, new deal volume dynamics, new downstream dynamics and so forth. So I think we're a far cry from having figured it out, right? I think we're continuing to learn as we go. I think partly with time and having seen a lot of deals, there are things that you can readily eliminate, right? I like to say for every 100 deals you see, probably a good chunk of them are deals that you immediately recognize are not a good fit for you, right? The hard part is always narrowing down on that remaining, call it 5 to 10%, right? How do you tell a MySpace from a Facebook, right? Substantially identical businesses on day one, but one fails effectively and the other becomes one of the largest businesses in history, right? How do you tell a Lyft from an Uber, substantially similar business, one is much bigger than the other? We think that's where the hard work normally is, where you're in the right neighborhood, you know the business model you're going for, you know the market you're going for, but it's really hard to tell who's going to break out and be an A+ generational category defining company versus who's going to flare. And often that, in our opinion, that boils down to human dynamics. It boils down to team dynamics often. And we've been in a lot of situations where we've done all the filtering, we've done all the screening of the opportunity, and by every logical or rational parameter, we were in the right place, but the team didn't work out, right? And that's in some ways the joy and sometimes the terror of doing early stage investing. But yeah, I'd say that's how we think about deal flow.
Yeah.
I can only agree with this. There's probably the question you're asking is about how do we go from the 100% to the 20 or 10% we need to focus on. And ultimately here, for us, it's a blessing to see that much deal flow, right? We should not be complaining about it. It's a sign of the dynamism of the ecosystem. Ultimately, it's, for me, a matter of putting the message out there on what is our mandate and what is not. The dream is, a self-filtered deal flow that perfectly matches your mandate, but that is not going to happen. The second one is, as a team, having regular conversations about what we are looking for, sometimes trying to be very, proactive about it, saying in this space, we think there is opportunities we should be looking for should have these and these characteristics, is a good conversation to have. Again, it should be nothing binding because we're all opportunistic. But we should have these conversations in advance and not have them one by one. That's something we're trying to do in our team. And I'm starting to be in this place where basically our team kicks us out of the room and filter things and bring us back. And we complained at the beginning, but I must recognize it works. They're much better at filtering things than we are, at least Cyril and I.
Fantastic. Annika, do you have anything to add?
I don't really have much to add. I think both Pardon and Tijan summarized things properly. I just would reemphasize the real work is in that 5-10% and figuring out who's the winner within that. And I think lots and lots of things matter, but team, as Pardon said, is everything, and judging that properly is not science. It's an art and it's a gut thing, and that's where you can do well or not do well. And so to me, that's really the big chunk of the work.
And
so I wanted to
sorry for jumping in here, but this delicate part that we're talking about here, I don't know about you guys, but I find myself needing to do it now more and more in a few days, because deals are becoming competitive, because entrepreneurs are, putting us under pressure. And it's interesting to note that we must do deeper, more fine work in crazy timelines.
Yeah, that actually brings me, it's a good segue to my next question, which has two parts relative to two events that came out recently, one around sexual misconduct in the ecosystem and another around some founders allegedly stealing some investors' capital. So the first part of the question is given these, this pressure and the competition for capital, how are you guys managing due diligence and trying to keep up and not miss the best quality deals? And the second part of the question is when you're investing, I think governance is something that is very much overlooked and probably, frowned upon by most founders for taking seriously when they're trying to focus on, keeping their customers, facing really high growth and raising capital. So it's just another thing onto their do list, and nice to have rather than a need to have on day one. So how are you managing these two probably pretty unpopular, but I think pretty necessary aspects of picking the most successful deals and making sure they do become successes?
It's the nightmare scenario, huh? We probably all lose sleep on. But to be frank, the speed should not come, should not go against being thorough. I think the challenge here is doing it fast while still doing it really well in terms of due diligence. Of course, if you had more time, things would float up. It's easier, but we still have to do it. But I think it's beyond due diligence. It's what do you do once you are in? Do you make sure that you capture, you spot very early on any signs of misconduct and, speak up? Do you make sure that the company has the right governance structure that make sure these kind of things are rooted out? Because even for founders hiring people, they can make mistakes and hire the wrong person who would do the wrong stuff. So for me, it's been more of a matter, how do you react and react well and put in place preventive measures than having a crystal ball and being able to predict and avoid all of this.
Maybe I can add on to that is things have sped up a lot, but I do not think you can compromise on due diligence, especially in fund strategies like ours, where we put in a ticket early and then we follow through follow-on rounds. You need to do the job and need to do it well. So our strategy helps us a little bit in that we get to see kind of pre-seed opportunities, hopefully before they come to funding. So we are able to build not always, but a lot of the time, relationships with the entrepreneurs and use that as a filter to figure out whether we would want to fund them or not. Because as we talked about, team is everything, and a good team will manage through bad times and good times, and a not so good team can very quickly unfold in bad times. And then of course you can have all sorts of other issues. So for me, getting to know the entrepreneurs is really, really key. It's a very long-term relationship. So you want to make sure you're with the right parties. And then once you're in, you, as Tijan said, you really need to spend time with the companies, which means, lots of frequent interactions, and hopefully, get to a point with the entrepreneurs where you're their eyes and ears because you've helped them a lot. In our case, we have a focused fund strategy, so we will not invest in a lot of companies. So hopefully have the bandwidth to do that. But it's really key to be able to see what's going on in the business and identify things early. And as Lexi said, corporate governance is not always loved, but I think it's a really value-add proposition. That's how we try to position it to startups, to convince them that they will be more attractive for the next round of funding because they have done that. So we try to focus on that relatively early on, in addition to all the other support we can provide to companies.
Yep. Sometimes I feel though that we're up against US-based VC firms who certainly don't put that pressure on the companies. So, there's some competition for capital as well in the best quality deals.
Absolutely. But my view is sometimes you have to skip things. It's amazing what you can unearth in due diligence. So you just have to do due diligence. It's just, for me, it's honestly non-negotiable. We try to do it fast. Faster than before, but you can't not do it, especially as an institutional fund with institutional LPs. It's not possible.
Yeah. And maybe just to add to this, I think there's a very real tension, right? There's a very real tension between being able to move and be agile and move quickly, right? Especially when founders are increasingly sourcing capital from international investors for whom these are not necessarily meaningful bets, right? These are not necessarily core positions of their portfolios. They are a little bit of variety, a little bit of spice. Their core portfolios are built somewhere else where they are doing a ton of due diligence, right? But founders are reaching there and then creating pressure. There's almost like a cycle, right? Where they then create pressure on how much we need to be able to move quickly. So I think it's a very real tension, but I think the way we've thought about it is in the long-term success in an endeavor that involves more than one party is a function of fit, right? How well do people fit with each other? And for us, the view is the right fit founders will appreciate, they will have the sobriety and the presence of mind to appreciate that we need to do the homework that we need to do, that there needs to be governance in place, that these things are to the benefit of everybody in the long term. And that means that we will miss out on things that need an answer by the end of the week, right? And that is entirely fine. I think the goal for us is not to be in every successful business in Africa, but is for the ones that we're in to be successful, right? So we may miss out statistically and categorically, we will miss out on certain things that move very quickly and end up being very successful. And that's entirely fine. I think a rising tide lifts all boats, right? If those people are successful, we're all successful at the end of the day because the ecosystem wins. But ultimately, I think our job as CRE is to partner with founders who are taking a similar perspective as we are and are willing and prepared to have a really, really long multi-year relationship in which we hopefully continue to invest with them, funding round upon funding round upon funding round, right? So it's much less transactional. And look, that means that we'll miss out on some things, right? And as frustrating as that can be, I think you play the game that you win, right? So if you're playing tennis, you have to know you're playing tennis. If you're playing squash, you have to know you're playing squash. You can't conflate the two, right?
Yeah. Well, I think it's worked out well for you guys already. I've seen some incredible returns coming out of CRE. So we're wrapping it up, but I want to throw out one last question, and please make it short because I think we're already going over. I'm going to give you 2 tickets, and they can't be split. So $1 million and $10 million. Where are the 2 opportunities that you place these investments in today? Whoever is ready, please start.
1 million digital security, 10 million some of the subsets of fintech or supply chain that I mentioned.
Fantastic.
I'll cheat and put the 10 million on an existing supply chain startup. and I'll put the 1 million in an noticed Francophone African startup.
Great.
That's interesting. I don't know that I have good answers for this. Set up new funds to invest some more. Build new portfolios. I don't know. I think, sorry, I don't mean to dodge the question, but really like talk to founders and see whom I think, we understand and is potentially a good fit for us, and maybe commit all $11 million to them over multiple rounds of funding. I don't know. That's I know maybe I'm not answering your question directly, but that's how I'd probably think about it. Yeah.
No, that's okay.
Yeah, Lexi, so bouncing the question back to you, you can't cheat, you can't split it. 1 million, 10 million, where would you put it?
Okay, well, I'm going to assume that the 1 million is my own money and not my LP's money. So I'm going to put it into a crypto-related venture builder on the continent, where I think there's a lot of opportunity, but certainly high risk and certainly some governance risk around that as well. And then the 10 million, you know, what I would really like to see and back is somebody that's really doing a Pan-African interoperable, you can call it a neobank or transfer or payments or remittance or whatever it is that works seamlessly, quickly, without high fees, and very clear and robust AML policies. Those are my two investments.
Very good.
Thank you so much, guys.